Hello, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way for you to exit highly appreciated cryptocurrency, businesses, real estate, so you can defer millions of dollars of capital gains tax, and so you can create and preserve more wealth or help your clients do the same. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial, wealth, crypto, and sometimes tax minds in the world where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expertcresecrets.com as well. I appreciate everyone there, and of course, capitalgainstaxsolutions.com. And I'm excited about our next guest. He's out of California. He's on the front line of tax strategies and figuring out ways to be IRS compliant and to help his clients and the folks that he serves to create and preserve more wealth. And he is a part of or owner of U.S. Tax Advisory Group that combines technology and engineering expertise to utilize compliant practices that follows IRS tax code and U.S. law. And their objective is to help business leaders optimize income tax deductions and credits, maximizing their growth by increasing profitability, developing environmental friendly energy solutions, and obtaining higher returns on investment. And so much more. Please welcome to the show with me, Joe Viery. Joe, how are you doing?
I'm doing well. Thanks for having me on your show, Brett. Appreciate it.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, my story is this. I've always been an entrepreneur, and I owned a business which was not related to real estate for 20 years. In 2000, I sold it, and then I started working for the California Association of Realtors, CAR, and I was helping their members and also their members' clients in tax strategies. And that was involving financial planning and, insurance products, yada, yada, yada. And then something happened in 2007 and 8, and the car drove off the cliff, and the membership of CAR went to pretty much skeletons. There were not very many active realtors back in the day. Prior to that, somebody asked me about this, or they wanted to talk to me about this new tax strategy, and I blew them off and blew them off. Finally, I said, okay, tell me your story. He told me about cost segregation. I had clients that needed it. They had a $50,000 income tax bill staring them in the face. I got them into cost segregation. And then when the economy disintegrated, the owner of that company said, hey, why don't you join my firm? And so since 2007, I've been in the cost segregation industry.
Fantastic. Before we dive into all the top secrets about that and the amazing, amazing benefits that cost segregation provides, I want to take one other step back, Joe. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Maybe go back to your high school days, right? Maybe the college days, the earlier days, and talk to us. What are those maybe one or two gifts that you believe you were given, and how does that help how you help and bless people today?
Well, actually, I think one of the gifts, or two of the gifts, one is I have an incredible sense of humor. And maybe that's not a gift, but I think it is because, helping people laugh and taking their mind off the mundane things in life is one of my gifts. And, I don't get myself drugged down into the depths of despair. So I think that's probably the number one.
That's a great gift. Yeah, yeah, absolutely. Especially when you're dealing with tax, right? And all this, the heaviness of like,
Yes.
oh, the IRS and tax, and oh my gosh, I got this big tax bill that I didn't know about, and I'm wondering if you could save the day, Joe, and bring in the cost seg, expertise to help me figure this thing out. So let's dive right into that. So
Okay.
what's the number one secret to cost segregation, right? As well as making sure that you stay compliant, leveraging this tool, and maybe a couple others we'll touch on here, so that you can create and preserve more wealth.
Well, like every strategy out there, there's the right way and the wrong way to do it. And what the IRS, I'm not going to go into the depths, but what the IRS did is they sued the Hospital Corporation of America, and the Hospital Corporation of America won. Part of that case, which was in 1997, is the judge who did not like the IRS's case at all, said, look, you've got to tell everybody that they should be doing cost segregation and how you want them to do it. So in 2004, the IRS published the Audit Technique Guidelines for Cost Segregation. It's online. Everybody can read it. If you're not getting to sleep at night, read this 200-page document. And so bottom line, that gives us all the rules. If you want a quality study, the IRS tells you how to do it. And so our mantra from my very beginning has been following the audit technique guidelines and doing it correctly. So my biggest tip is find a company out there that follows the audit technique guidelines and does, the guidelines gives you 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 steps of what you need to do to perform a quality study. And that's our mantra. That's what we do.
Perfect. And by the way, you can learn more about Joe. It's such a
Fiery.
It's fiery, right? Fiery with a V, baby. Fire with a V. Viery at USTAGI.com. That's USTAGI.com. Okay, great. So first thing is understanding that what's available for you, what's out there, and then working with a group that is going to make sure to follow the letter of the code, right? And do the necessary steps. Of course, you probably want someone that's experienced and has done lots of these, and they perhaps had to defend this versus their clients versus the IRS when it did an audit or something along those lines. But at the end of the day, cost segregation is what, Joe?
Cost segregation is relatively simple. It's very complex, but it's simple. All we're doing is we're accelerating the depreciation expense the IRS allows building owners. And what depreciation is simply the IRS recognizes that you're using up your building. It is decaying in front of your eyes through every year that you own it. So for residential buildings, straight line depreciation, the IRS says divide by 27 and a half years. How they came up with that, I don't know, and I never looked it up. For commercial buildings, it's 39 years. And so all we're doing is telling the client, do you want to wait 27 and a half years to get all of these deductions? Because don't forget, if you want to defer or eliminate your not defer, but if you want to eliminate your income taxes, the higher the expense items you have, the lower your taxable income. It's very simple bookkeeping. Anybody understands that. So what do? We give you that depreciation all up front in the tax year that you buy the property. So we're not doing any hocus pocus. That's all we're doing. And that gives you the ability to take a big chunk of that depreciation and use it against taxable income.
Yeah, it's one of my favorite strategies, right? And you're exactly right with multifamily, 27 and a half years, commercial, 39 years. And then also if you can buy, first of all, it's cash flowing producing real estate. It has some value add opportunity and that you're buying it on the intrinsic value, but also you can leverage very low interest rate debt. And that can help you get the full amount. Remember, your depreciation schedule is based upon not the land, right? Because the land's maybe 20% of that. But let's say you bought a $10 million building and $2 million of that is subject to the land. So you have $8 million of depreciable assets. Multifamily, we've seen about 25% of that $8 million in that year 1 or 2 is generally what you can do, right? And so we're talking, in that scenario, just to break it down for folks, if you take $8 million by 25%, that's $2 million, right? And let's say you had a gain somewhere else for $2 million, or you're in a 1031 exchange and it's failing and you're like, oh my gosh, what am I going to do? Well, you have that $8 million deal, you have that $10 million deal over there, which $8 million is you can do 27 and a half years on. Why don't we accelerate that and wipe it out? Is there anything I'm missing there, Joe?
No, do you need a job? So that's excellent. That's exactly what we do. And it's so powerful. I'll go a little step further though, because that is basically, as you explained it, on a value add, that's phase 1. Mm-hmm. Phase 2 is what do you do to the value add? Is you rip everything out. And I know what you do in multifamily because we do lots of multifamily. You know what you do. You rip out the countertops, you rip out the flooring, you rip out the window coverings, blah, 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 blah. You throw it in the trash and you put new items on there. So the other part of our study, what you get with cost segregation, is you get the value of the stuff you throw in the trash. That is a tax write-off. You want write-offs. Then the third thing we do is, let's say you spend $1 million on the renovations, then we do the acceleration on the $1 million.
Okay, so make sure I got that one because I like that little nuance there, and we like to geek out on these type of subjects on the Capital Gains Tax Solutions podcast, right? That's the whole reason we're here. So yeah, step 1 is just the you bought the value for 10. 2 million is not applicable because it's land, so they have 8. Now you can depreciate, boom, that, and then let's say that's year 1, let's just say, and you're saying like let's say year 2 you're starting the renovations, right? And at that point you're saying as I'm tearing stuff out, I get additional bonus on that, or
Yeah,
walk me
it's
through?
not a bonus. Here's how it works. In
Yeah.
2014, the another great tax bill came to play, which was called the Tangible Property Regulations. And so what the IRS said is, look, man, we're done with all of you guys scamming us. So now we're going to make bright lines so that you guys can't expense your dog and all of these things. So they gave us rules, a rule book. Part of the rules is they do not want two items on your depreciation schedule.
Hmm.
So what's item number one? Item number one is you bought the building for $8 million. Here's the building. In that $8 million, and this is why you need an engineer, is the allocated cost for all the building components. So guess what? The roof is in that $8 million. So if you put a new roof on, you basically now have two roofs. You have the old roof in that $8 million. You have the new roof that you spend $100,000 on. And the IRS is going, no, 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 you got to get rid of one of those. So obviously you're going to get rid of the old roof. Well, how do you know how much that roof is worth? Well, it's not worth what you paid the roofer for, because that was for the new roof. It's what was baked in that $8 million. And guess who defines that? We do. So now you know what your write-off value is on that roof.
Got it. Got it. And so that's stage two, which is awesome. And then stage three would be all the new stuff that you're bringing in there, right? Which I guess essentially you're doing another study, or would you do like are you doing a second study
Another
at that
study.
point?
Another study. Yep.
Yeah, another study. Okay, cool. So you do another study, and you're like, hey, we just put on new roofs, new countertops, new flooring, new windows, right? Blah blah blah, all across the thing, and then boom, you do it again. And so yeah, it's like the gift that keeps on giving. It's like, Christmas come multiple times, Joe.
Well, a lot of people don't get or don't apply. They just forget about the disposition abandonment study part of it. And you don't need me to do that. Once you get one of my studies, you've got the cookbook, so you can figure out what that linear footage of each of whatever kind of countertop you have that you threw. Let's say you started with laminate and you went with you converted to granite. So you're going to see on my schedules laminate linear square feet, and let's say you disposed of 1,500 linear feet. You'll know what the recipe is to put a value on that laminate.
Perfect.
And it's compliant.
So let's talk about bonus depreciation, right? Because that was one of the cool things that the Trump tax plan went through, and they got some extra cool stuff. In fact, it might have even been before that, but maybe he made it even better. Be that as it may, it's here right now. So what is it, and when is it set to? How is it going to be decelerating in the next couple of years? And in particular, I want you to talk to those who have active income, and perhaps they're a married couple, and one is high active income. The other one is, let's say, a stay-at-home mom, or maybe not working full-time, right? And this idea of real estate professional and the ability to potentially offset income tax on active income through buying real estate and doing what you just said. Could you kind of put that cube together for us, that a Rubik's Cube, make that all line up?
Okay, so what we're dealing with here is we provide you with your losses or depreciation as you are a real estate investor. So basically, you're either active or passive. Active means you're deriving most of your income, your primary income, from real estate. Passive means you're an engineer and you have an engineering income, and you work for somebody, or your own person, but that's your primary source of income. So you would be passive on your real estate. And so bottom line is, you brought up a great concept, is the married couple, because you could then designate your spouse as the active participant. And all the spouse needs to do is spend 750 hours per year on helping you, which is 20 hours a week. And the 20 hours a week can be anything related to real estate. You go to the south of France and you go look at real estate for a day or two. Well, that's part of your 750 hours. You read a book. That's part of your 750 hours. So bottom line is, what I see a lot of my clients do is they take and make the spouse who is a stay-at-home or is not working, has an active income, and they're making her the active partner. Because I have a lot of clients who are passive investors, and they still use cost segregation. However, there are limitations, and those are accounting. That's an accounting concept, and we're not accountants. We are engineers.
Okay, so I want to make sure everyone just caught that, right? Because this is like, I mean, the 121 exclusion is awesome, right? Like, we're like, oh my gosh, you buy a house for $500,000, you sell it for $1 million, it's tax free. Like, That's probably like the cat's meow, right? You can kind of do that. This is like maybe even better depending on your circumstance, right? Or at least close to this, close to how amazing this is, right? So if you're hearing this, right, there is potential. Get with your CPA. I'm not a CPA. No, there's Joseph. We're not representing that, and every circumstance is a little bit different. But understand what is actually possible with cost segregation, with buying investment real estate, particularly multifamily, 27 and a half years. Again, think of it in a Rubik's Cube, right? And I like to say, Joe, it's no longer about cash flow. It's about tax flow, right? Now, it's always been about both, but it's more and more and more, the scales is moving towards tax flow, right? And this is where you've got to be with pros. They're going to help, tax flow ninjas, who all have their shields and their little spears and all little specialties, like Joe's being cost segregation and mine being the Deferred Sales Trust, and all of us getting together around, you as the high net worth individual, the millionaire, and we're all fighting, right? Otherwise, you're vulnerable from multiple angles. And so the point is, how do you align this a Rubik's Cube? And imagine all the different colors on different sides right now. Well, you get with Joe and you throw it to Joe, and Joe kind of moves it a little bit. And then you throw it to your CPA, he kind of moves it a little bit. And then if you're exiting an asset, you throw it to me, and I kind of move it a little bit. And basically, we continue to do this where I watched this cool little documentary on kids that do a Rubik's Cube. Joe, I don't know if you've seen this one, where in like 6 seconds, these guys can take in a Rubik's Cube and they go like this and they put it together. I'm like, wow, like my mind is blown. And so this is what I'm talking about. So you hear these
18
things.
days.
Yeah. And so talk about, Joe, the whole concept of this, like hiring the who, not being the how, right? Getting that, not only that professional CPA, you might already, and most of our listeners, probably 90% already have that. So I'm not saying that, but getting those to level up, because there's CPAs that are kind of backwards looking in the sense of they're just talking about what happened. They're saying this is what happened, versus those that are proactive and working with cost seg specialists like yourself. Just talk about the importance of that.
Well, the one thing is most people who own real estate, most clients, well, I wouldn't say most, but a lot of them just don't have the right accountants. And you need an accountant who understands real estate, because I will tell you right now, the average accountant probably doesn't know how to spell depreciation, does not know anything about depreciation. So what do? They just kind of ignore it, and they just get out their calculators and divide by 27 and a half. Done. They don't need a Joe, and they don't want a Joe in their life because, they're going like, well, I don't want this strange guy coming in. Here's what we do. We will work with your accountant. I'm part of a team of people that will work with the client to figure out the best strategies. I do not care which way they go. We really honestly don't, meaning that if you find another strategy, or if you have another, situation where but at least, get me on the phone call with your accountant, because we don't charge for that. I will get on your accountant and I'll explain the nuts and bolts. I will answer his misconceptions, because honestly, there are some situations where you shouldn't do accelerated depreciation, but they're so rare that I can count them on one hand or maybe fingers.
Yeah, let's do a little lightning round on that, right? That'd be good. And by the way, I couldn't agree with you more, right? It's likewise. There's just because the CPA hasn't heard of it, or is not familiar with it, or doesn't have their client that's done it. You got to realize from their perspective, they're seen as like the doctor of tax in a way, right? And so when you come in and you say, hey, I've got this other specialist over here, sometimes they can feel threatened, or sometimes they're just so busy and they just don't have the time. They're like, I got so much going on, and I don't want to say yes to something that I haven't either done personally or had a client do, that it's going to come back on me. And so their default answer is, no, I probably wouldn't do that, or no, it's probably not worth it, or whatever. Yeah. Whatever their objection is. But if they say yes and it does work out, well, Joe looks really good and they made it look okay. But if they say yes and it doesn't work out, then all of a sudden they're held liable. So it's this whole like kind of circular thing. We face the same thing every single day on the Deferred Sales Trust. Although the tax attorney CPA is the one who created it, right? So we're not claiming to be that. We say, hey, no, come talk with our CPA and tax attorneys. The ones that are the brain surgeons, if you will, the doctors of tax. And honestly, 98% of the time, when they actually sit down and spend time with us, not only do their eyes open up, but they join us, and they actually start sending us referrals, and they become a part of what we're doing, which is, by the way, if you're curious about the Deferred Sales Trust, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. But let's go into the situations where it's not a good time to do it, Joe. So first of all, what's the minimum, right? What you would say, Brett, I think you need to have at least X to make it make sense in general, right? And again, there's a lot of other things there, but what's kind of the minimum?
Okay, so here's the difference. One of the main differences between U.S. Tax Advisors Group and a lot of others out there is that we do two types of studies. I told you that our bread and butter, what we do is called the detailed engineering study. That is the number one type of study written by the IRS and the ATG, the Audit Technique Guidelines. We also do another study, which is down the list, but it's called the modeling study. And we will do that for buildings with a basis of $500,000 or less. The reason I bring that out is because there's very few people that are doing these types of studies, and there's a lot of folks out there that own real estate, but they own single family homes all over the country. So now they can enjoy accelerated depreciation by using a modeling study, which basically costs hundreds of dollars versus the detailed engineering costs thousands. Because on the detailed engineering, we are going out to the property and we are measuring all of the building components, and the engineer will do the takeoffs on all of the measuring that we do in the field. So obviously those kind of studies cost thousands.
Okay, so let me make sure I got that. So if you, by the way, does it work for a primary home? Yes or no?
No.
Right, because it's only investment property, right? You cannot depreciate your primary, but you can depreciate an investment home. Number two, are you saying that an investment property, you want it to have bought it for about 500,000? Is that 700 or so, and then 500's there, or is that 500 and then 300 with the 20% or whatever
I always talk in terms of the building basis, and the building basis, as you're alluding to, is in California this is maybe not true, but if you take 20% off of what you paid for it, and you'll get to the building basis. And that line is kind of moving. We used to be really entrenched on 500,000, not $1 more. We wouldn't model. But nowadays we're refining our algorithms. And so we will do buildings that are even more than that, 500, 600, 700,000.
Okay.
And
building basis, right? So to clarify, so like if you bought it for 800, your building basis might be 650 or whatever, right?
Exactly.
Okay, got it. So
you buy for $1 million and you take 200,000 off for land, and now you've got an $800,000 building basis. And we could even do a revised modeling study on that $800,000. So it's not necessarily going to cost you. And there's a lot of multifamily out there around the United States that people are picking up for 6, 7, 800,000.
Got it. So that makes a lot of sense. What is that average cost? Just generally speaking, what's a modeling study cost?
600.
Okay, $600. Awesome. Now back to, let's say someone's selling. They're like, hey, I got this 15-unit property. It's worth $3 million, but I'm going to be selling it here in the next year. Why or why not use the cost seg study?
I personally will tell you, because I deal with a lot of CFOs. And the answer that we've all come up with is 2 years of a hold. There's a concept called depreciation recapture. And because you're using this expense and you're reducing your income, when you sell the building for cash, only cash, you have to pay some of that back. 25% tax or depreciation recapture tax on the building. So unless you're going to hold it for 2 years, or your IRR, if I give you $1 and your IRR is 80% on that money, well, then forget the 2-year hold. But most people aren't in that category. So what we say is, look, if you're not going to hold it for 2 years, I can take your money, but we don't want to. We don't want you to pay for something where it's going to wash out if you sell it within 2 years. So I suggest a 2-year hold is what people should think.
Perfect. By the way, get with Joe, cost seg specialist, USTAGI.com, USTAGI.com. So
real quick though, one thing we missed bonus.
Yeah, let's talk bonus. Yeah, let's go back into that. You're right. Let's talk about bonus. Go ahead.
We got off track. So here's the deal. In the Trump tax, I'll just call it the Trump tax bill. Bottom line, if you bought a property September 25th of 2017, it would qualify for 100% bonus. Now, is that a big deal? It's not a big deal, but it's very nice because prior to bonus, what would happen is the way that taking the 5, 7, 15, and 27.5-year property, which is the 5, 7, and 15 is what we can accelerate. You basically would get a big chunk the year you did the study, and then you get trails because you have 7 and 15-year property. So you're not going to get it all the first year. You're going to get most of it, and then 2, 3, 4, 5, you're going to get some more of the bang for your buck. But with the bonus depreciation at 100%, you're going to get all of what we find in personal property and land improvements the year that you do the study. So all of that 25% that you suggested as an estimate, you'll get that all. That $2 million, boom, you get that all in the tax year you do the study.
That's amazing, right? And this is where you high income earners, cryptocurrency millionaires, real estate millionaires, you've got to know and be executing on this, because bonus is set to start to wind down. I believe it might be
This is the
80.
last year.
Yeah, this is the last. So next year it'll be what?
You know what? People ask, but I'm so in the moment. I believe it's going to graduate over 4 or 5 years. It's going to
Yeah.
graduate down. So in 2023, I think it's going to be 80%.
Right.
And
Right.
then it's going to be 60.
60 and 40. Yeah, but the point is get going right now is the best time to do it.
Yes.
So I want to shift into part of what we do, and I'm curious on your take on this as a tax professional. With the cost seg and different things that you're doing here. So we specialize in something called a deferred sales trust, not a Delaware statutory trust, not a 1031 exchange. And we have a deal where we just helped a cryptocurrency owner exit. She bought Bitcoin for about 50,000 and it went to 50 million. And we talked about the concept of tax flow versus cash flow. And part of why she never sold until she met us was because of this huge tax. And so she started with 5 million. She lives in the Silicon Valley, worked for a big Silicon Valley company. Now she's retired from that, but she was able to exit this 5 million into the trust. Now, part of a cool thing that we can do is you can partner with the trust and you can go buy a business, you can go buy real estate, and you can become active, all tax deferred. So it's kind of like a self-directed IRA. But what's neat is you can get that new depreciation schedule on that asset, of which you can get up to 80% personally. You can't get all 100 the way we structure it. But just talk about the concept of being able to exit cryptocurrency, diversify into like real estate, get a new depreciation schedule, and then, oh, by the way, let's do a cost seg study here. And let's get a lot of this working for you. So I'm trying to combine these multiple things. So any thoughts on that, or what questions would you have as a tax specialist?
You know what? That is going to be outside my area of expertise. But when my eyes lit up when you described that strategy, and I think that is one hell of a strategy if you can capitalize on resetting your depreciation clock and getting your depreciation expense. And now that we're in bonus, I mean, my gosh, that is, anybody who meets that profile should run and talk to you.
Yeah, and honestly, we think we think it's the Netflix of old blockbuster ways of doing things. By the way, to be honest, we think most 1031 exchanges, the old installment sales, they're all blockbuster. What you guys are doing, especially with bonus, you guys are closer to Netflix, right? You're right, for sure, right? Now, what we think with that, we're like really Netflix, right? So you're on our side, so we cheer you on. But I've been in commercial real estate my whole life, and people's brains explode, and my brain exploded too. And I learned about it at Marcus and Millichap at the crash. Like part of the crash, you talked about how things shifted for you and everyone else. It's the same thing happened with us. We're like, there's got to be a better way, and there was, and there is, and it took a while to do the deals and go through I call it the 10,000 hours of brain surgery, watching the surgeon do the surgeries, and just keep putting people back together. You become a believer. So our mission is to try to make these real. And so we just did a deal in Alabama, $2.6 million business sale, and he's building 70 multifamily units, tax deferred, ground up, right? And he's using it with the Deferred Sales Trust. Otherwise, he couldn't have done it. You can't 1031 a business. You can't 1031 crypto. You can't 1031 a primary home. We did an $8.3 million primary home sale in Palo Alto, a 7.9 in Santa Cruz. But the point is, hopefully everyone's being encouraged here to challenge the status quo and don't just take what your CPA, who may be dealing with Blockbuster, right, for these Netflix types of strategies. And you can go to capitalgainstaxsolutions.com to learn more about that. That being said, are you ready for the lightning round?
Uh-oh. Yes.
All right. Knowing what you know now, Joe, if you could go back to your 25-year-old self, what's the one golden nugget and make sure to tell yourself to do?
Brush my teeth. No. Honesty. Integrity.
Excellent. Number 2, what's the number one book you've recommended the most or given in the past year?
Think and Grow Rich, man. I'm telling you, I'm an old dog, but that is, I think any youngin' out there, that's the book I tell them to read first.
Excellent. What are you most curious about right now?
Politics.
Yeah, that's a good one. Next one. What's the number one leadership quote or theme that you strive to live by?
Pass.
Wait. Okay.
You wanted a quote though, right?
A quote or a theme, and it doesn't have to be an exact. Yeah, if you can't think of one, that's cool. It could be an inspirational movie or inspirational book. I don't know, whatever.
Okay.
It could be Winston Churchill, right? It could be like a figure. It could be, you know.
Well, Winston Churchill's a good one. Yeah,
Okay, we'll go with that one.
I'll take that. Yeah.
Check that guy out. If you haven't heard of that guy, check him out. Okay. Next one would be this. After all your success, helping all the people you've helped, how do you stay centered? What's the one habit you try to practice daily to stay centered in your values and stay encouraged to charge forward to reach new heights?
Pay attention and stay focused on friends and family.
Awesome. Hey, Joe, I want to thank you for being on the show. I want to thank you for your sense of humor. You know, I came out on the show and it was fun. And you're right. It made a subject of cost seg and taxes and us geeking out about that. I think our listeners really appreciate it, and I sure appreciate it. So I want to encourage you to keep using that gift to help people create and preserve more wealth. And for our listeners who want to reach out and get with you right now for a cost seg study, would you mind one last time, what's the best place for them to find you?
www.ustagi.com.
Excellent. Thanks, Joe, for being on the show. And I also want to thank all of our listeners for listening to another episode of the Capital Gains Tax Solutions Podcast. As always, we believe most high net worth individuals, crypto millionaires, commercial real estate owners, people who are in 1031 exchanges, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust, or getting with Joe on a proven strategy at the cost seg study is the best way to defer millions, maybe even eliminate a lot of tax so you can create and preserve more wealth, or help your clients or friends and family do the same. Please go to capitalgainstaxsolutions.com. Please get with Joe on his website for that. And then if you are interested in our mastermind, it's our crypto DST mastermind. It's every Friday. I want to invite you. It's totally free. You can bring your CPA. You can bring your friends, family. You can bring anybody. It's real estate. It's business sales, all of it. But we talk to the Deferred Sales Trust and how this whole thing works so that you never have to feel trapped by capital gains tax ever again. Thanks so much, everybody, for listening.